Welcome to the deep dive. If you've ever felt, well, maybe a bit overwhelmed by those statistics about wealth transfer, the ones, the shocking finding that 70% of wealthy families lose their fortune by the second generation,
Hmm.
and then 90% by the third, if that worries you, then this deep dive is definitely for you.
Oh,
We've sifted through quite a bit of noise, the legal jargon, all the financial advice out there to try and build a single comprehensive playbook.
it really is a high-stakes problem. And, the sources we looked at show it's rarely just about investment returns failing. It's usually about a breakdown, a failure in communication and education, and critically, not having the right legal and tax architecture set up. So our mission today is really to create a shortcut, if you will, to the sophisticated strategies and the foundational habits that let families beat those odds. We're trying to move beyond just basic saving here, more towards, well, actual dynastic planning.
Yeah. And we are going deep on this. We've synthesized strategies that cover basically a whole lifetime, starting with, how do you teach a 5-year-old about the concept of value? Seems basic, but it's foundational. All the way up to some pretty advanced tax maneuvers used by ultra-high net worth families,
Yeah.
things like irrevocable dynasty trusts,
Mm-hmm.
and the tricky nuances of, say, the backdoor Roth IRA.
Exactly. We'll spend a good chunk of time unpacking the specific financial vehicles, custodial accounts, Roth IRAs, 529s, and then we'll pivot to the complex world of the gift tax framework. Understanding how the IRS views gifts it's absolutely essential for long-term planning. We really want to arm you with the knowledge to use these tools efficiently and, importantly, avoid costly mistakes, unnecessary taxes, or even worse, family disputes down the line.
Okay, let's get started then. So we've kind of established that building this financial dynasty means pretty much nothing if the next generation isn't prepared to handle it. It really seems like a classic case of nurture over nature here. Our sources are very clear on this: financial discipline. Things like budgeting, investing, saving. It's a lifelong skill, and it's instilled primarily through practical application, usually starting right at home.
Yeah, it's definitely encouraging that, 35 states now require a personal finance course for high school graduation as of 2024. That's progress. But that formal education, it really only provides the mechanics, the how-to. It doesn't necessarily teach the emotional discipline that's required. Things like delaying gratification or how to handle major financial setbacks without panicking. That kind of learning starts much, much earlier.
Right. Okay, so let's unpack this across what the sources see as 3 crucial phases of development. All right, for the little ones, the focus is pretty simple, right? Establishing the concept of value and responsibility. The sources strongly recommend starting with an allowance, but, and this is key, not just a free handout. Tip number 1 is really about tying that allowance directly to chores. It's about instilling a strong work ethic from the get-go.
That connection between effort and reward is, well, psychologically powerful. It just is. When kids receive money simply because they exist, it kind of teaches consumption, just spending. But when they get money because they completed a tangible task, maybe taking out the trash or helping with dishes, it teaches production, value creation. And this is paramount. They really need to feel the difference between spending their earned money versus spending, mom and dad's money. The research actually shows children make far more prudent choices when the money they're about to spend required their own labor to get.
That makes perfect sense. Yeah. The immediate consequence of that choice is just so much clearer for them. And that leads right into tip number 2. Emphasize saving. If they want, say, a toy that costs $50 and their allowance is $5 a week, well, that's your golden moment. Right, that's when you teach delayed gratification.
Precisely. And you need to encourage a consistent habit here. Maybe setting aside, say, 10% of all money they receive, allowance, birthday money, whatever. A lot of families use that classic save, spend, share, jar system. You've probably seen it. The goal is really twofold. First, teach that short-term patience for immediate goals, like the toy. And second, introduce the concept of long-term planning by setting aside money they might not touch for years. This routine helps combat that instant consumer impulse right from the earliest age.
Okay, so moving on. Phase 2, teenagers. This is where we shift from maybe saving for a toy to managing, well, actual assets.
Yeah.
Tip 3 is about introducing actual investing, often around the preteen or early teen years. And the sources suggest the best vehicle for this is usually a custodial brokerage account, like an UGMA or UTMA.
Hmm. And here's a key insight from the successful families we looked at in the source material. The parent shouldn't just be the passive investment manager in the background. You really need to turn this into a learning lab for the teen. Let them research companies they already know and use Nike, Apple, maybe Nintendo. Let them choose stocks, perhaps even fractional shares if the amount is small. This gives them agency, right? And a direct link between the economy they see around them and the assets they actually own.
Okay, but what if? I mean, if the teen is managing the assets, what happens if they make a truly awful investment choice? Like something tanks. Should the parents step in? What do the sources say there?
It's a great question. The sources generally suggest that intervention is actually counterproductive unless the mistake is, truly catastrophic financially. If they lose $100 on some speculative stock pick, well, that's probably the cheapest and most effective financial lesson they will ever learn. You facilitate the research, you manage the legal structure of the account, sure, but you allow them to feel the consequences, both good and bad. That said, it's crucial to set up regular performance review meetings, treat it almost like a board meeting for their personal fund, discuss diversification, talk about risk tolerance, explain why markets are volatile sometimes.
That's fantastic advice. Okay, tip number 4 builds right on this. Encourage a summer job.
Yeah.
The research seems to consistently confirm that young people who work actually become better long-term savers.
Oh, absolutely essential. It's crucial for understanding real-world cash flow and budgeting. You should require them to save a portion of that paycheck, maybe 25% is a common suggestion we saw. And importantly, mandate that they pay for their own small discretionary expenses, things like gas for their car, movie tickets, snacks with friends. This forces real-world trade-offs. Do I buy that new video game or do I save enough so I can actually afford to go out with my friends all month?
Right. Those practical choices.
Yeah.
Okay, next we move into what might be scary territory for a lot of parents. Credit. Tip 5 is introducing credit responsibly.
It doesn't have to be scary, not if it's managed correctly from the start. The recommended approach is often enrolling the teen as an authorized user on your established credit card. This helps them start building a credit history, which is absolutely vital later for things like mortgages or car loans. But, and this is critical, it must be strictly controlled. It should probably only be used for, say, practical emergencies, like a flat tire or an unexpected expense while traveling, not for everyday spending.
And what's the mechanism then for teaching the responsibility part? How do you enforce that?
By requiring them to pay back every single dollar they charge immediately, like as soon as the charge appears. This is the mechanism that teaches them to spend only within their means, and it helps them understand that credit is debt, it's not free money. This is also the perfect time to really explain the difference between a credit card, which allows revolving debt, often at painfully high interest rates, versus a debit card, which uses money they already have in their bank account.
That distinction is so important. Okay, finally for teens, tip number 6. This one feels like maybe the most powerful gift of time you can give them, the Roth IRA. Once the teen has earned income from that summer job maybe, they actually qualify for a contribution up to the amount they earned, capped by the annual limit, of course.
A Roth IRA, yeah. Funded with after-tax dollars today, it's absolutely ideal for a teen because their income and, therefore, their tax rate are likely minimal right now, probably zero or close to it. That low tax burden makes paying the tax upfront on the contribution a huge bargain in the long run. I think, the audience really needs to visualize this potential. If you contribute just, say, $2,000 when they're 16, and that money grows tax-free until they retire, maybe at 65, that single $2,000 contribution could easily become $100,000 or even more. It's potentially growing completely tax-free for 5 decades. The power of compounding is just immense there.
Yeah, it's less about the dollar amount they put in now, although that helps, and more about establishing that starting date, getting that clock ticking, starting a retirement account with their very first paycheck. That creates an inertia, a habit, that can really set them up for life. Okay, let's fast forward a bit. Phase 3, young adulthood. They've maybe graduated college, landed their first real job. Now they're managing potentially substantial income, maybe student loans, rent. It's a whole new ballgame. Tip 7 from the sources. Help them set a detailed budget based on their actual gross and net salary.
Yeah, and this really needs to be a collaborative process, not a lecture. When they've never really lived completely on their own, those fixed expenses are so easy to underestimate: rent, utilities, insurance, car payments, student loans. It adds up fast. You can help them distinguish between those fixed must-pay expenses and the discretionary ones, the fun stuff. Can they realistically afford the big streaming service bundle and that expensive gym membership and eating out 3 times a week? That prioritization lesson is just essential right now. And this is also the absolute crucial time to review their employer benefits package, especially any matching contributions to a 401k or maybe a 403b.
Oh yeah, that matching money it's truly non-negotiable.
Yeah.
Free money. If they skip contributing enough to get the full match, they are literally leaving a 50% or even 100% immediate return on the table.
Exactly. Maxing out the employer match should be the single most important first financial step in any new job. period.
Okay, tip 8 is about encouraging them to stay invested for the long haul, reinforcing that classic mantra. Time in the market is better than timing the market.
Hmm.
But for new investors who might feel overwhelmed by all the choices, what does our source material suggest for keeping it simple? How do they get started without getting scared off?
Simplicity really equals consistency, especially early on. For novices, the sheer complexity of picking individual stocks or niche sector funds can cause, well, analysis paralysis. They just freeze and do nothing. So the sources suggest two really simple, low-cost avenues. One is target date funds. With these, the asset allocation, the mix of stocks and bonds, automatically shifts from more aggressive to more conservative as they get closer to a set target retirement date, like
Yeah.
2060 or whatever. The complexity of rebalancing and adjusting risk over time, it's taken care of automatically for them.
Okay, that's one option. And the second,
Robo-advisor services. These online platforms automatically build, monitor, and rebalance a diversified portfolio, usually made up of low-cost ETFs, on their behalf. This really helps remove the emotional element from investing decisions, which is huge, especially during market downturns. And it ensures they maintain diversification without needing to constantly tinker with it manually. If you can automate the savings and investing process, you dramatically increase the likelihood they'll stick with the plan, even when markets get choppy.
makes sense. Automate good habits.
Hmm.
And the final, often overlooked educational piece here is tip 9. Let them know they're not alone. Financial anxiety is incredibly common, and making poor financial decisions can be a really expensive way to learn.
Yeah, the goal here is to normalize seeking outside help or counsel. They need to develop the habit of asking for help before a situation becomes a crisis. And crucially, they must learn to distinguish trusted, licensed experts like certified financial planners, CPAs from, well, unverified media influencers or personalities they might see online, whose advice is not only unregulated, but often based on selling a specific product or service rather than serving the client's actual best interest. The ability to critically evaluate financial advice is really a hallmark of true financial literacy. Knowing who to trust is key.
All right, we've really hammered home that the education piece is non-negotiable. But education needs tools, right? You need the right accounts to make the plan work. So let's dive into the specific vehicles parents and grandparents often use to move money efficiently, often with significant tax advantages. Starting with the ubiquitous custodial accounts, the UGMA and the UTMA, Uniform Gifts to Minors Act and Uniform Transfers to Minors Act.
Right. These accounts are really the entry-level transfer vehicle. They're generally very easy to create, usually requiring just some simple language to establish an adult custodian who manages assets for a minor. They allow you to gift various types of assets, cash, stocks, bonds, sometimes even real estate, depending on the state and the specific type of account. And crucially, unlike an IRA or a 529 plan, they generally do not have annual contribution limits. You can put in quite a bit.
And they offer pretty favorable tax treatment, especially early on, under those kiddie tax rules.
That's right. For 2024, the first $1,300 of unearned income, that's interest, dividends, capital gains generated within the account, is actually tax exempt. Completely free. The income above that threshold gets taxed initially at the child's typically lower rate, up to a certain point, and then it can jump up to the higher trust and estate tax rates. But still, the ability to have investment earnings grow tax efficiently, or even tax-free early on, is a huge advantage for compounding.
Okay, but here comes the massive planning hurdle, the thing that often catches people completely by surprise. The issue of control.
Yes, this is the biggest drawback, hands down. It's the irrevocability of control transfer. The funds transfer outright and completely to the child beneficiary once they reach the age of majority. That's usually 18 or 21. It depends on the state you live in. Once they hit that specific age, legally, they can liquidate the entire portfolio and, well, buy a sports car, fund a round-the-world trip, or, frankly, do anything they want with it. The donor, the custodian, they lose all say. And furthermore, these assets are considered the child's property for college financial aid purposes. This can often drastically reduce their eligibility for need-based grants and scholarships. It counts heavily against them.
Wow. Okay, so that inherent lack of control is precisely why many families, especially those dealing with larger sums, move to the next layer of complexity. Which brings us to custodial accounts versus actual trusts. Why would someone go through the hassle and expense of setting up a trust when a custodial account is so much easier to open?
It really all comes down to flexibility and control, particularly when you're talking about significant amounts of money or specific family circumstances. Trusts are generally more complex to set up, yes. You'll almost certainly need an attorney. But they offer vastly more flexibility and allow the grantor, the person setting up the trust, to establish very specific distribution instructions. For example, you can write into the trust document that the money must be used only for qualified educational expenses, or only for medical needs. You can even make distributions conditional on the beneficiary meeting certain criteria, like maintaining full-time employment or staying drug-free.
And the age of control is fully customizable too, right?
Right.
Unlike the UGMA-UTMA.
Exactly. With a custodial account, control is absolute and automatic at 18 or 21, no wiggle room. With a trust, you can dictate that the age of outright control is, say, 25 or 30, or you could even stagger the distributions. Maybe they get one-third at 25, one-third at 30, and the final third at 35. This is also the preferred mechanism, almost essential, really, for managing funds intended for a beneficiary with special needs or disabilities. In those cases, the trust might manage the assets for the beneficiary's entire lifetime to ensure they have stable care and financial support without disqualifying them from necessary government benefits like SSI or Medicaid.
Okay, that makes sense. Trusts offer control, customization, protection,
Yep.
but with more complexity and cost. All right, moving on. Let's talk about the tool designed specifically for education savings, the 529 plan. Seems like almost everyone with kids hears about these.
Yes, the 529 plan is an absolutely essential tool in the college savings toolkit for most families. The key benefits are pretty straightforward. The money grows tax deferred, and then withdrawals are completely tax-free at the federal level and usually state level too, provided the money is used for qualified education expenses. And qualified expenses is broader now than it used to be. It includes college tuition, fees, books, room and board supplies, and even up to $10,000 annually per beneficiary for K-12 private school tuition in many cases.
The contribution limits are also significantly higher than most other savings vehicles, like Coverdell's or IRAs, which makes them great for grandparents or other relatives who want to contribute substantial amounts without immediately triggering that gift tax framework we mentioned.
That's a huge point. An individual can gift up to $18,000 per beneficiary in 2024 without needing to file any gift tax paperwork. That's the annual exclusion amount. But if a family member wants to really front-load the plan and get more money compounding sooner, they can actually gift up to 5 years' worth of annual exclusions all at once. So that's up to $90,000 per person, per beneficiary, gifted in a single year. They just have to elect to spread that gift formally over 5 tax years on their tax filings. This can massively accelerate the savings potential.
Okay, here's where some recent nuance comes in, though. A major new feature, starting in 2024, has made these plans even more attractive for some families. The 529 to Roth IRA rollover benefit.
Yes, this is a really big development. It's a huge incentive, especially for families worried about the what if I oversave question. What if the child decides not to go to college or gets a full scholarship? This rollover option addresses that fear. However, it comes with some very specific critical constraints that you absolutely must know about. It's not a free-for-all.
Wait, what are those constraints? What are the catches?
All right, first, the 529 account itself must have been open for at least 15 years. This is designed to ensure the 529 wasn't just opened recently as a temporary tax shelter purely to funnel money into a Roth. Second, there's a lifetime limit of $35,000 per beneficiary on how much total can be rolled over from all their 529s into their Roth IRA. Third, the amount rolled over in any given year is also subject to the beneficiary's annual Roth IRA contribution limit for that year, considering any other contributions they might make. And finally, the rollover amount cannot include earnings generated within the last 5 years. Effectively, it's limited to contributions and older earnings. These strict rules ensure it functions as a genuine safety valve for leftover funds, not as a primary Roth funding mechanism designed to bypass income limits.
Wow, okay, that 15-year rule is a really crucial piece of detail. It means you pretty much have to plan this out right after the child is born or very early on to lock in that timeline and make the rollover option even possible down the road.
Absolutely. Foresight is key there. And finally, just a quick note for our international listeners, particularly in the UK, we should briefly mention the UK equivalent of some of these accounts, the Junior ISA or GISA. It allows contributions up to £9,000 annually per child, with all growth being completely tax-free. Then, much like the UGMAU-TMA in the US, it automatically converts into an adult ISA when the child turns 18, putting the funds entirely under their control at that point.
Okay, now we are definitely moving into the advanced category, firmly. We're going to kick things off with the gift tax framework. This often causes, well, maybe unnecessary panic for people. Let's try to clarify how it actually works for most families.
Yeah, that's a good goal. Most people hear gift tax and they immediately imagine the IRS is going to penalize them for giving their child, say, $5,000 for a graduation present. That is generally false. The federal gift tax is very rarely actually paid by most individuals because there are two enormous exclusions that shield most gifts.
Okay, let's break those down. Exclusion number one, the annual exclusion.
Right. For 2025 and 2026, the annual exclusion amount is set at $19,000 per recipient, per giver, per year. So an individual can give $19,000 to as many different people as they want each year, their child, their grandchild, a friend, anyone with absolutely no tax consequences and no paperwork required. And importantly, a married couple can combine their exclusions through gift splitting. They can effectively give $38,000 to one person each year, like a child or grandchild, again, without filing any gift tax return whatsoever. This allows for massive, gradual, completely tax-free wealth transfer over time if you utilize it consistently.
Okay, that covers most typical gifts. But what about really large gifts? That brings us to exclusion number two, the truly vast one, the lifetime exclusion.
Exactly. Any gift you make to one person in a single year that exceeds that $19,000 annual exclusion doesn't immediately trigger a tax bill. Instead, the excess amount simply reduces this much larger pool, known as the lifetime gift and estate tax exemption. For 2025, that amount is a whopping $13.99 million per person. You only actually start paying the federal gift tax, which can be up to 40% after you've given away more than that entire $13.99 million cumulative amount above the annual exclusions during your lifetime. So clearly, this is a threshold only reached by the ultra-wealthy.
So for most people, the primary takeaway isn't necessarily avoiding the tax itself, because they likely won't ever pay it. It's more about avoiding the reporting headaches and the tracking requirements, right?
Correct. The main consequence for most people giving gifts over the annual limit is the paperwork. Exceeding that $19,000 annual exclusion means you must file IRS Form 709, the gift tax return. The purpose of this form is simply to track that excess gift amount against your $13.99 million lifetime exemption. It reduces the amount you can pass on tax-free at death. And the sources we reviewed outline some common scenarios that trigger this required filing, often by accident because people don't realize these actions count as gifts.
Okay, what are some of those common triggers or mistakes people make that force them to file that Form 709?
Well, one is simply making large direct gifts of cash or property. If you gift your sibling, say, $50,000 in cash in 2025, well, $19,000 is covered by the annual exclusion, but the excess $31,000 reduces your lifetime exemption. You have to file Form 709 to report that. Another common one relates to those large 529 contributions we talked about. If you use that special rule to gift, say, $90,000 in 1 year to front load a 529, that triggers the requirement to formally elect to spread the gift over 5 years. And you still have to file the Form 709 for all 5 of those years to properly document the spread election.
Right, the 5-year spread needs documentation.
Well,
what about paying for big expenses for family members, like weddings or education?
This is a big area of confusion. You have to watch out for paying non-tuition or non-medical expenses directly to the individual. For example, paying for your daughter's $30,000 wedding reception directly, or giving her cash for a lavish honeymoon. Those are considered taxable gifts, subject to the annual limit and reporting if exceeded. However, there's a massive crucial exception here. If you pay an educational institution directly for tuition costs, or if you pay a medical service provider directly for healthcare expenses for someone else, those payments are completely excluded from the gift tax rules, regardless of the amount. You could pay $100,000 in tuition directly to Harvard for your grandchild, and it doesn't count as a gift, doesn't use your annual exclusion, and requires no Form 709. That direct payment exception is huge.
Wow, okay. Direct payment for tuition and medical is key. And what are maybe 2 more subtle, often misunderstood triggers related to ownership or loans?
Yeah, 2 tricky ones. First, setting up a joint bank account with a non-spouse, like an adult child. This is often done for convenience, but it's a potential gift tax trap. Because your non-spouse child now has the immediate legal right to withdraw all the funds in that account, the IRS considers that a completed gift of half the account value the very moment they are added as a joint owner. This differs from joint ownership of real estate, where the gift usually only occurs when the property title is formally transferred or sold. Second, giving an interest-free loan or a loan with a below-market interest rate to family or friends. Or forgiving a loan later on, the IRS treats the foregone interest, the interest you should have charged based on market rates, as a taxable gift each year the loan is outstanding. Forgiving the principal is also obviously a gift. Hashtag the backdoor Roth IRA, high-income workaround.
Okay, let's shift gears slightly back to retirement planning, but still in the advanced category. Specifically, the backdoor Roth IRA. This has become a really crucial workaround strategy for high-income earners who are otherwise completely blocked from contributing directly to a Roth IRA. That's because their modified adjusted gross income, or MAGI, exceeds the annual phase-out limits, which start around $165,000 for single filers in 2025, for example.
Exactly. And the appeal of the Roth IRA is just so compelling.
Yeah.
Decades of potential tax-free growth, and then completely tax-free withdrawals in retirement. It's the gold standard for tax efficiency. So the inability to contribute directly is a major frustration for many successful professionals and business owners. The solution that's emerged is this two-step backdoor Roth strategy.
Okay, walk us through the steps. How does it actually work?
It's conceptually simple. Step 1. You make a non-deductible after-tax contribution to a traditional IRA. This step is allowed regardless of your income level. There are no income limits on making non-deductible contributions. Step 2. You then immediately, or very quickly, convert the entire balance of that traditional IRA contribution into a Roth IRA. This whole maneuver works because while there are strict income limits on contributing directly to a Roth IRA, there are currently no income limits on converting funds from a traditional IRA to a Roth IRA. That's the loophole it exploits.
Okay, it sounds almost deceptively simple when you lay it out like that. But this is where the critical complexity, the big potential pitfall, the pro rata rule, rears its ugly head. This trips people up constantly.
Yes. This is the tax trap that can completely ruin the strategy for many people if they aren't aware of it or don't plan for it. The pro rata rule applies if you hold any other pre-tax traditional IRA assets anywhere. And this includes rollover IRAs from old 401k, SEP IRAs from self-employment, or simple IRAs. The IRS aggregates all of these pre-tax IRA assets together under what's called the IRA aggregation rule. When you perform that Roth conversion step, the IRS doesn't just let you convert only the new after-tax money you just put in. Instead, it treats the converted amount as coming proportionally from all your combined traditional IRA assets, both the pre-tax amounts and the after-tax amounts.
Okay, maybe give us a clear scenario of how that trap works in practice.
Sure. Let's imagine you have $93,000 sitting in an old traditional rollover IRA from a previous employer. That money is entirely pre-tax. You got a deduction for it way back when. Now, you want to do the backdoor Roth, so you contribute $7,000 in new after-tax money to a separate traditional IRA for your backdoor strategy. Your total traditional IRA assets now add up to $100,000, $93K pre-tax plus $7K after-tax. If you then try to convert just that $7,000 after-tax contribution to your Roth IRA, the IRS looks at your total IRA picture. It sees that 93K, $100 of your aggregate traditional IRA balance is pre-tax money. Therefore, under the pro rata rule, 93% of your $7,000 conversion, that's $6,510, is treated as taxable income in the year of the conversion. Only the remaining $490 is considered a tax-free conversion of your after-tax basis. So you end up paying income tax on most of the conversion, largely defeating the purpose of getting after-tax money into the Roth tax-free.
Ouch. Yeah, that significantly reduces the tax efficiency, potentially making it not worthwhile.
Yeah.
So the key to a truly successful tax-free backdoor Roth conversion is having a zero balance in all other pre-tax traditional SEP and simple IRAs before you do the conversion step. Often the only way to achieve that is by rolling those existing pre-tax IRA funds into your current employer's 401k plan, if their plan permits incoming rollovers from IRAs. That gets the pre-tax money out of the IRA system.
Precisely. Cleaning out any pre-tax IRA balances first is paramount. And if you are doing this strategy, even if it's fully tax-free, you absolutely must file IRS Form 8606, non-deductible IRAs. Every year you make a non-deductible contribution, and every year you do a conversion. This form tracks your after-tax basis in your IRAs. Failure to file Form 8606 correctly is what causes people to inadvertently pay taxes twice on the same money later or incur penalties. Keep meticulous records.
Okay, good warning on the paperwork. We should also briefly mention a potential, though perhaps theoretical, legal risk associated with this whole process. The step transaction doctrine, is that something people need to worry about?
It's more of an advanced planning consideration, something high net worth individuals discuss with tax attorneys. But yes, while the IRS hasn't, as of now, formally challenged the standard backdoor Roth strategy as illegitimate, the step transaction doctrine is a long-standing legal principle. It basically says the IRS can collapse a series of distinct, individually legal steps into a single transaction if it determines the sole purpose of the multi-step process was tax avoidance and there was no other significant non-tax reason for the steps. Since the non-deductible traditional contribution is often immediately converted to Roth, some tax attorneys argue this creates a theoretical, though currently seen as remote, legal risk that the IRS could potentially try to disallow the transaction under this doctrine in the future. It just highlights why staying informed about current tax law and precedent is important, especially for more complex strategies.
Got it. Potential wrinkle to be aware of. And just quickly, there's an even more specialized, potentially more powerful version some people might hear about, the mega backdoor Roth. What's that?
Right. The mega backdoor Roth is a different beast, and it's only available for people whose employers offer a 401k or similar plan that specifically allows two things. One, after-tax contributions, separate from Roth 401k contributions, and two, in-plan Roth conversions or distributions of those after-tax amounts. The standard employee contribution limit to a 401k, pre-tax, or Roth is one thing, $23,000 in 2024, but there's a much higher overall limit for total contributions from all sources, employee plus employer match plus after tax, into a 401k that's $69,000 in 2024, maybe $70,000 in 2025. If the employer plan allows it, high earners who have maxed out their regular contributions can potentially make large additional after-tax contributions via payroll deductions up to that overall limit. These after-tax contributions can then often be immediately converted to Roth within the 401k plan itself or rolled out to a Roth IRA. This allows a massive acceleration of tax-free savings potential, completely dwarfing the standard IRA contribution limits. But again, it hinges entirely on the specific features offered by your employer's 401k plan. Not all plans allow it. Hashtag tag Dynasty Trust preserving ultra wealth.
Okay, shifting now to true long-term generational wealth transfer. Let's discuss dynasty trusts. These are definitely not for small estates. We're talking about advanced, usually irrevocable legal structures, primarily used by ultra-high net worth families who are seeking to ensure tax-protected longevity for their wealth, potentially across centuries.
That's right. The primary genius, the core mechanism of the Dynasty Trust, lies in its strategic use of the generation skipping transfer, or GST, tax exemption. So the government imposes this separate GST tax in addition to estate and gift taxes specifically to prevent wealthy families from simply transferring assets directly from, say, grandparent to grandchild, thereby skipping the estate tax that would have been due when the intervening generation, the parents, died. By allocating a portion of their $13.99 million lifetime GST exemption, which is currently linked to the estate tax exemption, to the assets placed into an irrevocable dynasty trust. Those assets can then potentially grow and benefit multiple future generations, children, grandchildren, great-grandchildren, even beyond in some states, without incurring any further federal estate or GST taxes at each subsequent generational transfer point.
Wow. Okay, so the asset itself is essentially shielded from transfer taxes as it passes down through the children's generation, the grandchildren's, and potentially even the great-grandchildren's deaths. That's incredible leverage.
Exactly. This is the very definition of true dynastic planning. The key advantages are pretty clear. First, massive long-term tax efficiency by avoiding repeated layers of estate tax. Second, professional management, as these trusts typically appoint a corporate trustee, like a bank's trust department, to manage the assets according to the trust's terms. And third, profound asset protection. Because the assets are owned by the trust, not the beneficiaries directly, they're generally shielded from the beneficiary's personal creditors, from claims and divorce settlements, and even from personal bankruptcy proceedings.
Okay, the benefits sound amazing for preserving wealth, but wait. That loss of control, you mentioned the fact that they're usually irrevocable. That sounds like a huge downside, right? I mean, the sources mentioned that the tax environment changes constantly, family circumstances change. How do you manage a trust that was set up 50 years ago under completely different laws and family needs? Doesn't that create problems?
That is the absolute central trade-off. Irrevocability means exactly that. Once the trust is established and funded, it is extremely difficult and sometimes impossible to modify its terms. Even if the family's needs change dramatically over generations, or if tax laws shift in ways that make the original structure less optimal, you might be stuck with it. You are essentially locking in a structure today based on current laws and assumptions for a future that is inherently unpredictable. That requires immense foresight and careful drafting.
And I imagine the ongoing operational cost must be pretty significant, too. It's not a set it and forget it thing.
Definitely not. Dynasty trusts require sophisticated ongoing administration. You have trustee fees, potentially investment management fees, ongoing legal counsel to ensure compliance, and annual tax preparation for the trust itself, which has its own complex tax rules. These costs can easily consume, say, 1% to maybe even 3% of the trust assets annually. So the complexity is high, the costs are significant, and the grantor, the person who created the trust, permanently surrenders control over the assets they put into it. The goal is long-term preservation and tax minimization, and achieving that often necessitates giving up that personal day-to-day control.
And this inevitably leads us to the sociological impact, right? The potential downside risk of what people sometimes call trust fund syndrome.
Yes, the sources we looked at address this extensively. It's a real concern. While the trust structure successfully protects the financial wealth, it can inadvertently stifle the beneficiary's own drive, ambition, and independence. When large guaranteed trust distributions are readily available without requiring personal effort, beneficiaries may lack the motivation to develop their own wealth building skills, pursue meaningful careers, or cultivate a strong work ethic. This can potentially undermine the very values hard work, entrepreneurship, prudence that likely created the family fortune in the first place. Many modern dynasty trusts attempt to mitigate this risk by including specific incentive clauses. For instance, trust distributions might be contingent on the beneficiary earning a certain amount of income themselves, or completing educational milestones, or engaging in charitable work, trying to encourage productive behavior. Hashtag the waterfall concept, insurance-based legacy.
Okay, before we leave these advanced tools, we should probably acknowledge that there are alternative, sometimes highly efficient strategies out there, particularly those that leverage life insurance. Life insurance offers some pretty unique tax treatment. The waterfall concept is a prime example, often seen discussed in the Canadian tax context, but the principles can apply elsewhere too.
Yeah, this is a clever strategy, often used in Canada due to specific tax rules there. But the concept is interesting. It's a way to transfer tax-advantaged capital growth down to a younger generation more efficiently. Here's how it typically works. A parent or grandparent purchases a tax-exempt permanent life insurance policy on the life of the child. The child is the life insured. They then fund the policy, often heavily, for a relatively short period, maybe just 3 to 5 years. During this time, the cash value inside the policy grows on a tax-deferred basis.
Okay, so they build up cash value quickly, and then they transfer the policy itself.
Exactly. Once the policy holds a substantial cash value, the original owner, the parent-grandparent, transfers ownership of the policy itself as a gift to the child, who is also the life insured. The child becomes the new policy owner. Under specific rules, like Canada's Income Tax Act, Section 148, this transfer of ownership can often be done tax-free. The key benefit emerges later, when the child, now the policy owner, eventually withdraws funds from that accumulated cash value, perhaps to help with the down payment on a house or to pay for university or maybe a wedding. Those withdrawn funds are taxed to the child. And since the child is likely in a much lower marginal tax bracket than the original high tax bracket parent or grandparent who funded it, the overall tax hit on accessing that growth is significantly reduced for the family as a whole.
Okay, so you effectively shift the future tax burden on the growth down to the person in the lower tax bracket. That's a net win for the family unit. Very clever.
It is, and there's an interesting control feature here, which can sometimes substitute for the complexity of a formal trust. The original owner, the parent-grandparent, before transferring the policy ownership, can name an irrevocable beneficiary for the policies. This irrevocable beneficiary, may be another trusted family member or advisor, must then provide their consent for any future withdrawals or loans taken against the policy's cash value by the child, the new owner. So this irrevocable beneficiary effectively acts like an informal trustee, helping to ensure the funds are used for the originally intended purposes like education or a home purchase without the cost and legal complexity of setting up a formal legal trust structure.
Okay, we've spent a lot of time building the financial architecture, the accounts, the tax strategies, the trusts. But as we touched on earlier, a true legacy has to be more than just numbers on a balance sheet. The sources we reviewed are absolutely unanimous on this point. Successful multi-generational wealth transfer requires addressing the holistic concept of legacy. It's got to be broader than just money.
Absolutely. Legacy isn't just about the financial assets, it absolutely includes the non-financial aspects. Things like tangible items with sentimental value, maybe the family home or heirloom jewelry, experiences built through family traditions and shared vacations, and crucially, the intentional transfer of family stories, values, ethics, and intellectual capital. Ignoring this softer side is what leads directly, the sources suggest, to that staggering 70% failure rate by Generation 2.
And for those listening who maybe aren't starting with millions, we really need to stress the power of incremental wealth building. Every bit of effort matters, right? It's not all or nothing.
It absolutely does matter. Our sources highlight that even if a major financial goal is only partially met, for example, maybe you only manage to save enough to cover half of your child's college tuition, not the full amount. That effort still has huge downstream benefits. The data consistently shows that college graduates, for instance, earn significantly more over their lifetimes. One source cited at least $630,000 more on average than those with only a high school diploma. So every investment made in education, in providing some initial capital and teaching those foundational skills, it matters profoundly in changing the trajectory.
Okay, let's look directly now at the flip side. The catastrophic failures. That incredibly high rate of wealth dissipation, 70% lost by the second generation, 90% by the third. It's not random. It seems directly traceable, according to the experts we read, to about 6 common recurring mistakes.
Yeah, they really boil down to a handful of critical failures. Mistake number one, simply avoiding money conversations within the family. Just silence. This silences the critical dialogue needed for planning and preparation. It leads directly to unprepared heirs who inevitably mismanage assets they don't understand. And it breeds resentment and disputes among family members who are left guessing about intentions after someone passes away. The fix here is proactive communication. Schedule regular family financial meetings or summits. And importantly, introduce heirs to your trusted financial and legal professionals early on, demystifying the process and building relationships.
Okay, that's huge. Mistake number two, not having an estate plan at all, or having one that's woefully outdated. This seems like the fundamental, maybe unforgivable omission.
It really is.